I want to pull up his formal bio because most of you know him, but for those that don't, he's been investing in real estate actively and passively for the last 6 years. He grew his family portfolio to 500 units before moving on to syndications, where he has now been involved with over $200 million worth of apartment transactions and over 2,000 units through his experiences as owner and also general partners through his latest partnership in Elevate Commercial Real Estate. I'm going to pass on to you now if you want to add anything else.
Yeah, that sums it up. A lot of you guys know. I got started here in Northwest Arkansas on a much smaller scale, 12 units, 20 units, 50 units, 40 units, building up a portfolio of 500 units now where we're taking down apartments like these, 376 units at a time, and syndication. So today I'm going to talk about how to analyze and look at multifamily deals. I will touch on the underwriting, but I think there is more to it than just looking at it based off spreadsheets. So I'll be diving into that on when you're looking at deals, what to look for, and all that. And apologize for the, we bought this property in January and we're starting to do some of the renovations, and I'll talk about that on here. And we actually, so this room actually used to be about 3 feet longer, so we brought it in because they were using part of that for storage. So now storage is on the other side, and this is going to be strictly a business center. So I'll talk about kind of the business plan and that once we get in here.
Yes, so plugging in here. I just wanted to mention, because typically our sponsor is the one that mentions about the sponsorship, but I forgot that he couldn't make it today. This event is sponsored by NWA Real Estate. Some of you may be familiar with David Butagali. This firm has about 40 years of experiences and $600 million in commercial real estate transactions. So if you see him next time, you'll know that he sponsored one of our events. So just wanted to throw that out there, and I think floor is yours, clicker's working.
Yeah, we appreciate that sponsorship, and we are open to other sponsorships too. If you're interested, reach out to Misi. Obviously, we have a mix of passive investors, active investors, commercial brokers, and our marketing goes to tens of thousands of people. So I'm going to be talking about this deal that we syndicated here. So we bought it actually in 3 phases. Phase 1 and 2, we closed in January, and phase 3, we're closing at completion of construction, expected to be done in July. We actually just wrapped up the equity rate, so this isn't a pitch or anything. Like, this is kind of my pitch to my investors, but we just got this fully committed, so I couldn't take your money if I wanted to right now on it. This is more for educational purposes. We do, I think, have an attorney here, SEC lawyer here, so always consult with your attorneys and your accountants before investing. So when you're looking at a deal, the title of this presentation was how to analyze a multifamily, or how to analyze a deal. So that's a super important part of any deal when you're underwriting the deal. But for me, I'm also looking, before I even get to that, I'm looking at who am I partnering with, who's the partnership, what market am I investing in. So I love Northwest Arkansas, but I can't buy every multifamily home here too, so I look at other markets. And even within Northwest Arkansas, there's the Springdale isn't the same as Bentonville. Bentonville isn't the same as Pea Ridge. Pea Ridge isn't the same thing as Rabbit. So you're looking at the market. So sponsor, market, and then underwriting. You want to see how the property has performed historically, and then how you expect the property to perform after you buy it. So those are 2 major importance. I kind of break down the underwriting portion into 2 different factors: how it's historically performed and how you expect it to perform after you buy it. And we'll talk about the assumptions that you get there. So the first thing that I spoke about, the sponsorship team. So for this particular deal, Elevate is a main sponsor. So we've been in a lot of partnerships. I've been in a lot of partnerships, whether you look at property managers as your partners, if you look at your banks as partners. Having good banking relationships are now more important than ever, as we're seeing a lot of banks are, they're saying, oh yeah, we can get you 80% LTC, then they go to their credit department, and their credit department, they come back, tail between their legs, oh, we can only do 60%. So the banking industry is changing a lot right now, so those relationships are super important to have property manager relations, and then actual partnerships, who is actually running the deal, who's going to be the owner. So for us, George, Eric, and myself are the partners at Elevate Commercial Investment Group. So I spoke a little bit about my kind of journey. When I was first doing it, I had 80 units that I had built up, personal portfolio. I did seller financing, I did some refinancing out of some smaller multifamilies, and I had no partners, no investors. My partners were what I talked about, the property management, construction teams. And then I brought on my father-in-law, and we started buying 50 units, 82 units, 14 units, 7 units, and that's when I built up that portfolio of 500 units, and he was my partner there. And I started to run out of doors in Northwest Arkansas to make offers on. And I knew I wanted to stay in multifamily, but I knew I had to look at other markets. I was either going to have to look at different commercial classes or different markets. And I chose that I wanted multifamily was going to be my vehicle. And so I started looking at other assets. And that's when I saw what Elevate was doing. They had an in-house construction team. They had about 2,000 doors at the time. They had operational experience. And for me, that construction aspect was super important. I could walk a 12-unit apartment and see, okay, something's wrong with that. But if I walked a 376-unit apartment, I would be pretty afraid to not have the construction. I could miss $1 million expenses, foundation issues that could change the whole deal. So having that construction background was super important. And I got along with them really well, good core values. That was super important for me. Now as a partner at Elevate, we have about 5,000 doors right now across the country: South Dakota, Texas, Oklahoma, Florida. We did a deal in Georgia, no longer own there. South Carolina, all over the country. And I'm able to do that because I have partners like Eric, George, Justin. He's our director of acquisitions. He used to be a commercial loan underwriter for Merchants Bank. We brought him on to underwrite our deals and head our acquisitions and talk to commercial brokers. And then Joel Fries, he's from Minneapolis. He that runs our asset management, and he used to run a property management company. So we brought him on to oversee our assets. And then Eric is the CEO. He's over the operations, kind of the bulldog of the group. He's making sure that Joel is doing what he needs to be doing, overseeing the operations. George, more the visionary. He has a construction background, so he's running that aspect too. So that's another reason why I like commercial real estate, is because you can teach it. The business plan is built to have teams in place. You're built to have other members of the team. Like, I didn't have any major problems when I was doing single family, but I knew that I didn't want to have to deal with property management. Maybe if you're nitty gritty, you like that aspect of it, but for me, my vision was not managing residents and tenants and that operational side. So I'm the CIO there, and I'm in charge of our equity. So all the investor relations, our large equity providers, you guys just missed them walking down with us here too. So they're a large equity, institutional equity provider. So managing those relations and making sure we're all set there. So that's our partnership on this deal. There's one of our exited deals. That was the deal we had, the deal in Augusta, Georgia. So when you're partnering, you want to make sure people have a good track record of what they're doing. Partnering with, if you're just beginning, you may not want to partner with someone else who is just beginning. You want to partner to someone who complements you, who has good strengths. If you just want to partner, you can get a dog or something like that. So a good partner is going to complement you and bring something that you don't bring to the table. So that's one of the deals we exited. One of our sponsors here, Tariq Al-Musa, if you're familiar with HGTV, he's bringing $5 million to this deal. So I think that speaks to the deal having that much brand awareness, and that's a big skin in the game. Being that visible in the public, to be able to put your name behind something was big for us. He's partnered with us on another deal in Dallas. These are the guys. Aspen Funds is based in Kansas City. They actually passively invested with us, passively invested with Elevate before I came on. They knew that I was here in Northwest Arkansas. They do a lot of different commercial real estate, and this was a $75 million deal. So they knew they needed someone like Elevate, someone local, and the size of Elevate to help them bring the deal to the table. So we figured out a partnership agreement. They do have asset management experience. We're taking the asset management lead, but they have some good insight there. They run different funds. You know, they have over they're involved in over $7 billion
Yeah.
real estate.
And Brian, just to add, I know it may sound like, he's just talking about partnerships, but whether you're investing passively or actively, when you're analyzing the partnership is where it's going to make or break the deal. So I just want to add some colors to what he's talking about.
Yeah, agreed. And you can chime in anytime you want here too. You know, that's the whole, are you betting on the jockey or the horse? I think there's, you want to have both. You want to have a good jockey, you want to have a good horse, you want to have good conditions. This is the jockey. And then Asset Living, that's the property management company we're currently using. It used to be Trinity. They're based in Fort Smith. I've had good experience with them on my Fort Smith portfolio. So they're currently running this property. They have a ton of experience. They've run some of our other assets. And like I said, property management's a good partnership to have. So we'll look at the investment overview. We purchased this for $73 million. We have about $1 million and $1.5 million budgeted for CapEx. If you guys walk around the property, it's pretty nice. The owners kept good care of it. It was just finished in 2018, 2023 build on the phase 3. So there's not a whole lot to be done, but we are building from the developer, and we wanted to add extra finishes, extra touches to bring this market rent up. We're going to project $200 a month extra in rent. We want to be able to justify that. So we're redoing this business center. We put on this mural right here in the business center. This used to be some tables and chairs. Right here, you see these are smart locks and smart thermostats. We're going to be installing. We already installed those on all phase 1 and 2, and we'll be installing that on phase 3. Right here we project 5-year hold, so that's going to be part of your underwriting. How long are you holding this for? Are you fixing and flipping it? Are you holding it for 3 years, 5 years, 7 years? For me, I think a 5-year term is pretty conservative to account for any market cycles. You always can strive to exit earlier, but when I'm setting expectations, I want to say that be prepared to invest with me for 5 years. That's at least what makes the most sense in my eyes, and apartment syndications to really get the max benefits. Here's the returns. We'll go more into these. Anything that I'm doing, I'm trying to double my money and my investors' money in 5 years or less. Here's the structure. We were talking about structures earlier before the start of this. So you can structure a deal, and that's another important thing to look at. How are you being treated as an investor? What is the structure? Long are gone are the back of you meet at a restaurant and 50-50 partnership on a napkin, where I think real estate has evolved way past the 50-50 deals. And for us, for our investors are getting the majority of the benefits. They're putting up the equity, they're putting up the risk. So we structure it in favor for investors. So we do what's called a preferred return. So 6 to 8% usually of the profits go to our investors before any split is paid to the manager. So that's what's called a preferred return. Then it goes to a 70-30 split. So 70% of the profits go to the investors and 30% to the active managers. And then we'll put in a waterfall, or what's also known as a performance hurdle. So if we get in there and crush it and we get an 18% internal rate of return, then it goes to 50-50. Some deals you'll see tons of waterfalls, 18%, 20%, different splits. We like to keep it at that, where it goes to 50-50, and then it doesn't cap. So we're incentivized to perform well on the property, not just buy it and sit on it. We want to actually get our investors a higher return, so then we get more of the profit sharing there. And again, that, even some would say this is a complicated return. 6%, 70-30. When I was doing deals, with my father-in-law that I mentioned earlier, we were doing 80-20 splits, 70-30 splits. When I went down to Fort Smith, I had to convince him to go to Fort Smith, and I had to do a 90-10 split on our first couple of deals there. But for me, I was just getting started, and I was willing to give up that amount of the equity just so I could start getting involved in Fort Smith. And we went on to buy several hundred more units there, so I wasn't so worried about getting 15%, 20% for me. So I think that's an evolving structure. We've done 60-40 splits on deals in Dallas, but I think a lot of people get caught up on this. How should I structure it? But you can be really creative as long as the numbers justify the split. You know, if I'm an investor and if I'm doing a 50-50 split and I can make, you know, 50% return, then I might do that. You know, as if that's where it is, I might pay a fee to see that. But I'm also wanting to see the underwriting to justify those returns. Here's the property. We're in phase 1 and 2 right now up here in the leasing office. Phase 3, this will be done. First 4 buildings will be done in June and July. Here's a cool overview of the property. And then some points, you know, so we want to talk also about the business plan. So that kind of goes to how you expect the property to perform after you've taken over. And a part of that is the business plan. So why I particularly like this deal is because it's off market. We were able to source it direct from the developer. You know, that's where a lot of your money on the buy is. I mean, we've bought on market properties before, but that's definitely a big potential path of progress. I could talk about Northwest Arkansas. You guys know the story about Northwest Arkansas. This property right here is 3 miles from the new Bentonville home campus, right on the border of Centerton and Bentonville. So we really like that. And then immediate growth potential of $200 to $400. So that goes back to the underwriting, how we're projecting our projections. You can say, oh, I'm just going to increase rents $200 a door, and then come to that evaluation. But it's, why can you increase $200 a door? What are you justifying that rent increases by? What is the market saying? What has the market done historically? What are other properties doing that? Obviously, a big proponent of your underwriting is going to be what kind of debt you can get. How high are you on the leverage? What's the interest rate? What are the terms on that debt? So, you know, you're seeing properties right now with floating rate debt, which people thought was a good option. And, you know, we've done some floating rate debt, but those deals, you know, are definitely like not as strong as a fixed rate debt. And that's something that you want to look at, especially now with the way the interest rates are going. So phase 1 and 2 has fixed interest rate on it. Phase 3 has fixed rate as well, but the phase 1 and 2 is going to be an assumable loan. So we're assuming a Fannie Mae loan, 3.49% interest rate, which is great. Phase 3, our interest rate will be a little bit higher, but our blended cost of capital will be lower. I'll go more into that on the underwriting. So here's the business plan. Bring up the market rent. So a lot of reasons I like buying from developers is because they're builders, they're not necessarily operators. They're, you know, no offense to them, they're really good at building. I can't build, you know, but they're not as worried on the operational soundness of it. So they're just trying to get it built up, get out their high interest construction loan, and go cash out and go build the next project. So we come in, find extra areas to improve, push market rents. So that's why I like A-class a lot right now. So when you're looking at properties, you want to look at, you know, does this business plan make sense for an A-class? You know, are you going in with an A-class business plan for an A-class property, or are you looking at a C-class property and doing those type of, you know, we're not going to add carports and smart locks and smart thermostats to a C-class property. We might fix up the exteriors, fix up the interiors, do some new flooring, something like that, but that CapEx improvement doesn't really make sense on a C-class property. So here's our list of CapEx. If you go around the property, you've seen we've already started, we've installed all the carports, and so that's something you really want to do quickly too when you're taking over these properties, or whoever you're partnering with, that they're implementing the business plan quick. One, it lets the residents know that new ownership is in place, and you're also able to start getting the increased net operating income. So you can see, if you guys saw the pool, pretty nice pool area, but it doesn't really, for me, it doesn't really scream A-class. So we are actually going to be resurfacing that, adding some furniture. Obviously, it's already pretty nice right now. They've done a really good job with the landscaping, pickleball courts, huge thing going on right now. One of the development projects we're looking at in Bentonville, also pickleball court. We're doing a deal in South Dakota. We're going to add a pickleball court to that, so that's one of our requirements. Electric car charging stations, we're adding that. We're sprucing up the gym. But these main ones up here are really the ones where we're adding the extra income. you know, this will add nice curb appeal, but you know, we're not spending a lot here, but here we can actually point to the extra income. You know, we're getting $75 a spot at least for each carport. Smart unit packages, we can increase our rent about $50 to $75 extra by having those smart locks and smart thermostats. People will pay extra for that premium feature. Garages and storage units. There's already some garages and storage units on there. We're adding more on there, so that's extra income there for those items. You know, so I talked about the market. So it's super important to know your market. Northwest Arkansas, you know, we know a lot about Northwest Arkansas, but within that, so we're looking at so you look at the macro market, which is Northwest Arkansas, obviously Walmart, Fortune 1 company, Tyson Foods, J.B. Hunt Transportation, University of Arkansas is the 9th fastest growing university right now. Walmart Corp, number 1. If you look up Northwest Arkansas right now, it's on a ton of top 10 lists right now. Best place to live. U.S. mountain biking just came here. One of the best performing large cities. So then that's kind of the macro look at it. And then we want to really dive down into the micro level of the market. So here we're looking at, okay, yes, Northwest Arkansas is great, but where are we positioned within Northwest Arkansas? Same thing if you're investing in Atlanta. Buckhead, you know, there's different areas of Atlanta that I would invest in all day, and then there's some parts of Atlanta I wouldn't touch with a 100-foot pole. So it's very important to get into the micro level of your market and look at where you are. I like to do, you know, I'm not doing it as much, but the underwriting and the data analysis, you know, we're looking at companies like Crumble Cookies doesn't put Crumble Cookies next to a C-class property. You're not going to sell $5, $10 cookies to different asset classes. Starbucks, Walmart. These companies are doing millions of dollars of research before they're placing a corporate center. So having the same thing, Whole Foods isn't here yet, but if you're looking at a different market, Whole Foods is always a good indicator if you're looking at a higher income tenant. So this is super important when you're looking at A-class assets, is looking at exactly where at in the market it is. And the market even changes if you look at the Maddox, which is way down here in Centerton, to watercolors. You know, the market, I think, you know, if I was buying land, you know, I'm pretty sure the Delaware LLC bought some land right here, and probably last name of Walton made that investment. But their Northwest Arkansas can only grow so much. So being on the path of progress, I think, is super important too, and that's kind of what this developer did, put it right here on the border of Centerton and Bentonville. Path of progress is huge, and this is the micro level of the asset. So same thing, when I used to invest in all my first 10 to 15 deals, they were in Springdale and Fort Smith. You know, some people were afraid of those markets when I first started investing in there, but I went in with a certain business plan. You know, I was buying apartments where rents were $400. There was even a 3 behind one of the rents that I took over. You know, $375 apartment is probably what you expect it to be. I learned quickly that just because a resident is living in it doesn't mean there's no issues. But I went into a business plan knowing where the markets were, knowing what I was going to spend on, you know, interior and capex, much simpler business plan on those. But that's a different business model. It's not like you can't make money in, you know, very nice markets, but you just have different business plans and different business models there. Obviously, you guys know about this project, super cool. Downtown, close to Bentonville. This one is 7 minutes from here. So if you go around here, when I was walking the apartments, most of the residents here are there's very heavy engineer presence. A lot of engineers for Walmart. Some of them don't have cars, they just work from home. So another reason why I like the A-class more and more. More people working from home, and more people can buy their home. So here's more market data. We're looking at the average income within the property. Go a little bit further. CoStar is an awesome, really good reporting for income data, rent data, sales data. We actually have CoStar rep here. If you guys are looking for market information I highly recommend them. Our Best Skyline report puts out a ton of good data. So you can go to different, if you're looking at different cities besides Northwest Arkansas, you can go to the Chamber of Commerce. And I was just in Rapid City, South Dakota. We met with their economic development team, and they love hearing, new people coming in to invest in their city, and they can give you all sorts of data there too.
Cool. Well, before we move into the financials, I can just kind of add and summarize what we talked about so far. So whether you're a passive or active investor, starting with kind of the big picture, some of the key pieces that he talked about, macroeconomically speaking, like the debt piece, right? It's really big. When you're investing in real estate, you always want to know what's happening economically speaking. And then he drilled down to Northwest Arkansas, right? You may or may not be investing in Northwest Arkansas, so understanding that market. And then he drilled down to Syndication specifically and what's around it. And all those are really affecting, along with some of the business plan in terms of CapEx expenditures or rent increases, it's really affecting income and expenses and what the resale value is. And that's really where you're going to be getting returns, whether it's as cash flows or as profits when you sell. So now he's going to go into some of the details of the numbers, but it all ties together.
Absolutely, yeah, great points there. So financial analysis, one of the most important pieces, those pieces are what I'm looking at before I even get into the financials. If someone sends me a deal in Memphis, Tennessee, I won't look at it. If someone's sending, people always hear, oh, you're in Arkansas, they send me stuff in Little Rock. I'm not buying, personally, maybe people are making money in Little Rock, that's fine, but I'm not looking at those markets. Yeah, so I've created my kind of deal criteria so I can focus, and then once I do find a deal in an area that I like, meets the criteria, then we do deep dives like this into the financial analysis. To start, we talked about it a little bit, but you want to look at what the comparables are. So where is the rents going? Are you buying at the top of the market? Are you buying at the middle of the market? Where can you compare this apartment to? So you can see right here, Watercolor to Centerton, how we looked at it. Phase 1 and 2 was finished in 2018, and we're trying to pull comparable properties. So you see 2016, 2020, 2019, even some older properties, A-class properties. I think, what year would you say? A-class, I'd say anything newer than 2005. I guess, it's kind of in the 2000s is when I would classify something as an A-class. So we get a good range here. And you look at where they're located, how far are they from the property, what kind of build they are, and then you can compare them. So here, when we took over, average rent was around $1,100. We're already achieving $1,300 right now, but to get to that conclusion, we were looking at some of these other properties. The point of it, the 2016 build, you see $1,100 to $1,650, $1,250, $1,373. Crystal Flats, obviously that one's a newer build, and that's actually closer to Bentonville, so you're getting a premium here. You can see Uptown Terrace as well. That's more, Pinnacle area, but you can see the difference in where it could go. Here's a better comparable. So this shows the year-built units, occupancy, how far it is from the property, and what the average rents are. Average comps 2019 build, and they were getting 260 right here. So this is where we knew, okay, there is a delta between what this developer is currently charging and what we can get. So developers, like I mentioned, they're just focused on getting it leased up as fast as they can. So they're just trying to get people in the door as they build so they can get it out and go build the next one. Here's more in-depth look at the rent comparables, looking at year-built square feet basis. Over 24 months, we have in our projections that we're going to get $200 to $400. So that's another thing to look at when you're underwriting, something I see a lot. People just say year one, boom, we're all of a sudden, every single, right at takeover, we're going to get $300, $400 rents increases. So you want to make sure that you're gradually doing that. If we did that, yeah, that might happen, but the vacancy would probably go down quite a bit. Phase 1 and 2, so here's acquisition data, purchase price, we're breaking it down into different phases, and then this is what we're projecting at sale. So we have a higher cap rate on our exit. We feel like that's pretty conservative given this market. You know, that's a big factor in your underwriting that Misi mentioned is the sales price. You know, a mix of that is cash flow, but the majority of your proceeds when you're looking at real estate in general is coming from that exit price. Unless you're just buying from there are some cash flow markets where you're just buying from cash flow where property might cash flow 10%, but then it might not appreciate quite as much. And for what we're doing is a mix, and a lot of that is forcing the appreciation from sale. Here's how we broke it down. So this was about a 30, I guess, if you want to look at it as the LP, we have raised about $29 million and an extra $10 million for preferred equity. So we had a preferred equity provider, Walker & Dunlap. They wrote a $10 million check. They actually, and that's what that preferred equity is, kind of what the stack was before. They'll give you a certain percentage, anywhere from 11 to 15, you know, it's currently around 15% for preferred equity, but they don't participate in the upside. So they're not getting that 70-30 split. They're not getting that. They just want their preferred return. They have large funds where they're just getting dividends. So we like that because it helps the return on investment for our investors. Also speaks to the strength of the deal, having someone that large come in and invest on a property like this. See the property purchase price, acquisition fee, which goes to the sponsorship team, what we have for legals, titles, third party. So this is super important when you're looking at a deal. Where are it's not just the purchase price and the down payment. It's purchase price, down payment, fees, CapEx, working capital. Those are all factored in. Here's the senior debt, phase 1 and 2, 3.49%. Fixed rate on the phase 3 today. So this was done, it would probably be closer to a little over 8%. And that's one thing too, we'll talk about here shortly, is stress testing the deal. Let's see if I have that quick. Yeah, so that's great if all the business plan goes well, but you want to make sure, you want to be able to stress test the deal. What happens if the market goes down? What happens if vacancy goes up? So this property in particular has a 60% break-even occupancy, so if this 40% of the residents moved out, we would still be breaking even. So that was a really strong factor when deciding to do this deal. And then you can see what happens to the returns if cap rates go up even higher, 5.25 on A-class deals. We're still achieving, 16% return to our investors. So that's part of what we're doing in the stress test of the deal. We also looked at what happens when you change the interest rates there too. So this is phase 1 and 2, underwriting phase 3, and then this is blended. So this is, Misi, you can chime in here too as part of the underwriting, but we got this from how the property performed the past 12 months, and then what we're projecting once we take over. So this is your top of line income, and then your bottom line expenses, and then this is what we're projecting on that operating income. So you have your rent. For properties like this, you have other income, garages, storage units, utility rebills, pet fees, other areas like that. So you'll have a little bit extra other income on A-class properties, C-class properties, and B-class properties not as much. And then total expenses, payroll, especially with apartments and these size of apartments, we're going to account for that. Your property management fee, whether you're managing small properties yourself, you want to make sure you have that underwritten. When I had my single family, I was still adding this management fee in there just so I could look at it when I exit, because the next buyer is probably going to have that. Real estate taxes is a huge expense. Obviously, Arkansas is a non-disclosure state, but you still want to account for that to increase. Insurance is another one that goes up, so you want to make sure just because the property has had this historical insurance doesn't mean that that's what it's going to be. Total expenses vary from property to property. New builds around 30%. Older builds could be upwards of 50%. Some of the Fort Smith properties that we were running were even closer to 55%. That's because and then Fort Smith, the owner pays for water, and that's a huge expense there. So knowing what's common in the market is super important when you're looking at underwriting. And I know there's some brokers here too. So when broker sends you pro forma, usually that's pretty optimistic. I think when I see a lot of the broker, every now and then broker pro formas are conservative, but it's one thing to put it on paper, but it's another to actually dig in on the underwriting numbers. And so for these taxes, we actually hired a tax assessor to come in and do best case and worst case. This was like $600. We paid $600 on a $75 million portfolio. I think it was a okay investment by us. And they'll go in, they call the county assessor, they'll do analysis on other properties, and they'll say, okay, this is what we think your property will be assessed, best case and worst case. And for our underwriting model, we're using the worst case scenario here. Not an average, not a best. We want to make sure we're accounting for worst case scenario. So you'll see that here in the real estate taxes. And that's the same thing. When you're getting this underwriting, that's good. Check with the brokers. They can give you their take on what it's going to be. I would check with property management companies. Send them your underwriting or ask them to do a pro forma on your property. They always have a good insight on how the property can perform, and you can always use that to, evaluate them as you're taking it over. So those are good sources for analysis. Here's the sensitivity, and then the big factor that we talked about is the sales price. So how do we get to the sales price? Well, we're looking at what's trading right now. And when we first got this under contract in October and November, there wasn't a whole lot of large apartment complexes trading. So we had to really dig in here on it. Now that we're sitting in May, there's Pinnacle Heights is under contract, Fitzroy is under contract, Uptown Terrace is under contract. So we're going to have a lot more comps, and those are around $250, $260 a door. But at this point, we only had this average of 146. So that was, somewhat of a risk that some people would say. But if you really dig in, the average comp was built in 2012. We have about a 10-year newer product. Our product, if you look at these other products, much more well-built, much better located, and these sales dates were 3 years, 3 years, 1 year. So if you look at the forward trajectory, you could see that where the properties are going. So this gives you a good base. So multifamily, that's a great thing about multifamily. It's evaluated based on the net operating income, just like a business. A business is evaluated when you go into Shark Tank. They are asking you, how much income are you producing? What are your numbers? That's the same thing how apartments are evaluated on the net operating income. It's not like a single family home. Your neighbor runs into a situation, they have to sell their property at a loss. That now affects your property. Sales comps do have a weight on multifamily, but not as much weight as the net operating income. So we're adding more weight on our financials than the sales comps. But it is good to know where properties are trading and to see different cap rates. So when we got this under contract, we saw that Pinnacle Heights was getting under contract. This is expected to close soon, $260,000 a unit. We're in at $194,000 a unit. This does have a retail component. Pinnacle Heights is in a different location. It appeals to the Rogers. We appeal more to a Bentonville community, and it has a retail component. But again, they kind of add some justification to that sale price. Here's what you're looking at as an investor. So I invest in all my deals too as a limited partner. I'm now in a position where most of my deals have a $100,000 minimum. I'm at least putting that $100,000 minimum alongside my investors. In this particular deal, I have $400,000 in it. And so this is what I'm looking at, because I want to be a full-time passive investor. That's my ultimate goal, is I want to be a full-time passive investor in apartment syndications. And this is what I'm really looking at. But to get to this, you have to look at everything I just talked about. This is what most people jump to. They straight jump to this. How's my returns being? But to get to this, you have to look at the underwriting, look at the assumptions, look at how the property has been performing. So, so 100,000 in equals 215, or I guess it's actually 229,000 when you add up the cash flow. So for what we're seeing right now, and what I've seen actually historically in the past 5-6 years, cash flow is relatively low. 4, 5, 6, 7, 8%. With the A-class properties, we're even at 3 to 4%. Here you see this dip to 2.6. That's because the interest-only period goes away there, and now we're paying principal against the property. So you get a little bit of cash flow throughout the life of it, but your big kicker is at sale. And these are the two, we have 2 different share classes, so you can get, so structuring a deal, you can get as complicated as you want, and we got a little bit more complicated with we had 500K investors. They got a little bit better preferred share class, so we did 8% preferred return, then 80-20 split until a 16% IRR, then 50-50. So for those larger check writers, a little higher incentive, but both of them getting treated pretty fairly here. One of the great reasons of investing in multifamily real estate and real estate in general, but multifamily real estate, you can do what's called a cost segregation. So you go in and you bonus depreciate everything, the appliances, anything that's not part of the regular scheduled depreciation, and you can accelerate that at a 5-year term. We hire a company called Madison Specs. They do cost segregations. If you have commercial real estate, I would recommend them. There's a couple other groups, I think, that you can look up. So for a $100,000 investment, you're showing a $70,000 loss approximately in 2023, and then 114 to 128,000 spread out throughout the life of it. So big benefit, and that if you don't use that all in your first year, you can continue to roll that afterwards. Here's the timeline. So real estate, it's pretty slow moving, but I think you have to move fast if you're going to be successful in this industry. When a broker sends you a deal, you give them feedback right away, whether the deal works for you or not. Whether once you start talking to lenders, send it to different lending partners, different property management partners, and making sure you're moving quickly there. So this one, we got under contract in October, and then we closed phase 1 and 2 in January, and then we're closing phase 3 in 2023 because that last phase is not, we're scheduled to complete that construction. We are, as I spoke, we just completed the funding. After closing, this isn't so much as a deal analysis, but this is something that's probably important to talk about. If you're partnering up, what are the partnership expectations? Yes, we want to come together and get this deal closed, but what happens after the deal closes? Who's in charge of running the property management? Who's in charge of the funding of the investment? Who's in charge of the lending? So that's something super important for us. We're taking, for our structure, our investors are passive, completely silent, no say in the deal. So they may like that, they may not, and that's also to protect them as a limited partner. So we're doing all that. Then we do quarterly distributions. It's currently how we set up. We'd like to do monthly, but it's a little more expensive and management intensive. And then we send out monthly updates every month on how the property is doing, how we're projecting towards what did our underwriting look like and how are we actually performing. And then right around this time, we try to get out K1. CPAs are super backed right now. Try to get them out by April, but and then we try to be available for our team. So that's why these are all the factors that I look at when I'm looking at a deal. And then we put this in just about investing outside of your local market, add some different areas. It kind of takes the emotion out. When you can't go check on your property all the time. When I was investing in Springdale, I would go drive by the properties all the time on the weekends. I don't know if that helped the property or not, but just having that access to it made me want to go check on the property. So now when I'm investing in Dallas, Florida, South Dakota, I can't get out there, so it's almost more beneficial to me. So I'm not. That was almost the same thing when I was investing in stocks. I'm sitting here watching the stocks go down, but I have zero control over what that CEO is doing. But I think that's an important factor when you start branching outside your market. and investing outside your market. Again, here's the projected returns, and yeah, that's all I had on how to analyze a deal, what to look for. You know, the numbers are super important, but again, that's not the only thing that I'm looking at. You want to go into a deep dive of the numbers, of the, you know, the team, the market, and the numbers. And then I'll leave it open to you guys if you guys have any questions, or if Nisi, if you had anything else to add.
Yeah, thank you for your presentation. I mean, Brian kind of spoke of it from a general partner visual presenting to limited partner standpoint, but you saw how he had a vision, right? He saw the property, how they assembled a team. Those are some of the things you have to look for. They're passive active investors, and they had a vision, understanding where the condition is at, and then what he just walked you through is essentially whether the P&L currently and whether P&L, how it would look like, how he would execute that plan with his team. A big thing to really understand is investment. You know, you can have potential to make $1 million, but what's the risk? So always, when he's going through those things, think about the risks factors as well. He tried to cover it with things like exit cap, sensitivity analysis. That's just one aspect of it. So, you know, having a good partner who knows construction is another good aspect of understanding the risks with foundations and everything. I mean, this is a new build, so likelihood is low, but...
Yeah, and even in this property, we still scope, you know, with it being a new build, we still had, you know, plumbing service come out and scope all the lines. Just because it's a new build, sometimes new builds, you know, they don't put in the plumbing correctly. I didn't know that you would do that with it being a new build, but the construction team said we've got to scope the lines and make sure that we're checking that, even though it's a new build. So that's what's super important.
Yeah, so that's essentially what this is. It's looking for risk-adjusted opportunities that meet your investment goals, whether you're passive or active investors. You know, now it's time for Q&A. If you guys have any questions, whether if you're looking to passively or actively invest in general, yeah, go ahead.
Brian, real quick, does your business plan on this particular property allow for meat on the bone at that 5-year exit, or you know, why or why not?
Yeah, I think that, you know, for our exit plans with the A-class properties, it's more for an institutional buyer. So a lot of the institutional buyers, they don't necessarily need a whole ton of meat on the bone, but that is a good point. Like when you're looking at the C-class builds and the A-class builds, is sometimes you may, if it's 140 units, you might only renovate 80 units and then you sell it to the next buyer. So where they're coming in and completing that, you're proving the business plan, and then they're coming in to recapture the rest of that. So, but for us on the A-class, there's not really any kind of oversight as try to leave meat on the bone. But I think that's more of a business plan with the C and B class properties.
Okay.
I know this might be hard to answer, but like the timeline from when you have people, you're looking at everything, plus you're going through your underwriting and do the cost saving and all that, but generally how long was that time?
60 to 90 days. Yeah, 60 to 90 days. And as we're queuing it up for, like, once we've got LOIs out and we're pretty close on where they want to be, that's when we start getting hard quotes. You know, we're talking to insurance. If we're pretty close on where we think we're going to be before we get it officially signed, we'll start getting insurance quotes. We'll start sending it to some of our lending partners and try to fine tune that as we get closer. Some of those big ticket items, try to have someone assess the real estate taxes if we know we're close. And if we don't get it, then that might have been a little waste of time, but you know, we're trying to queue that up. And then as soon as the agreement is signed, it's usually about 60 days that we're queuing that up, 60 to 90 days.
The cost saving portion.
Cost segre portion, yeah, we'll do that right about PSA.
How long do those guys take? Are they pretty quick?
They're pretty quick, yep. They can do an analysis pretty quick for you. There's like the cost I think there's a company called like the cost segregation something, and then Madison Specs is who we use. Trying to look at the other company, yeah, Madison Specs, but there's a couple other out there. But it's good to try to have as much, you know, hard numbers as you can before you sign the agreement, so you don't get any big surprises like, oh, the debt went here, or oh, my insurance was actually this. So, you know, having a good idea of where that is, and that's why it's having those good relationships with those kind of vendors is good too. So they don't mind running that for you, but most will.
Yeah, and also on larger properties like this, general partners take a lot of risks. There's usually a earnest money deposit, and you have usually 30 days to kind of do a due diligence. And if for some reason things don't pan out, I've seen people losing 6-7 figures
Yeah.
because
for
the
this
deal
prop-
doesn't pan out. So like talking about LP versus GP, right? There's like GP taking a lot more risks in their early part of the process, especially even later on as legal issues and things like that. So.
Yeah, that's part of it. For us, we're not putting any money hard day one, but some people do it. Like if it's Roy, there was $1 million hard day one. We were pretty close to $1 million, but that was contingent on our due diligence. So when we're getting under contract, we do have contingencies to get out. Of that 30 days, we have 30 days to come in and assess the property and make sure everything is what we thought it would be. So we're not doing a deal to get in and retrade. I almost maybe retraded like once, however many deals I've done, but you get in there and you're looking at it, and that's usually just because you're doing what I was talking about, scoping the line, looking at the property, making sure everything is where it need to be. But then if something's not what you're expected, you have that due diligence period to go back to the seller and say, hey, this is not what we expect. Like the property is actually not performing as well as you said it was after we've got some of the financials, so then you could go back. So all my offers are contingent on 30 days of due diligence. It's a good question though.
So what do you do differently on a new build versus an existing build? Is it all kind of into the financial modeling? Because you got to make some assumptions, right?
Right, exactly. Yeah, there are definitely assumptions on there, and you try to make it as best educated guess as you can. And for the new builds, for here it was kind of a quasi. You have phase 1 and 2 that we bought that was 96% occupied at takeover, and then we had phase 3, which was we're buying at 0% occupancy virtually. So we kind of had proof of concept there, but I'm looking at doing a ground-up multifamily development in Bentonville as one of my next projects, and you do have to make some assumptions there. We're going to be building this thing for 2 years. What are market rents today? What are market rents going to be in 2 years? How fast are we going to get leased up? So you just kind of look at other property for new build. For us, when we're looking at that, we look at how fast are other properties getting leased up. What is the market rate currently? We try to be conservative on where we think the market rent will continue to grow. NWA has had double-digit growth, but you can't put that on paper. Like as great as that is, we can see it here, but you can't put that on paper, double-digit growth for 5 years in a row. But if it does, that's great, but for us, we're trying to be a little bit more conservative on that.
Yeah, and it's also a different set of animals. You have to deal with the builder now here. So it's another player you guys have to engage with, right? Because you guys have construction experiences, but you guys don't have development experience. So you have to rely on another partner on the vendor side to help you provide that expertise. So it's another level of risk, sense of trust you have to build in. And also, big thing is loans. I think when I was looking at the deal, which you talked about in your sensitivity analysis, being that last year we didn't know what's going to be happening this year with all that talks. So it's good that you guys got an opportunity funded, getting close to be closed. So that's also another risk, because when you're building, a lot of the construction loans, they're variable. So you have, and the rate caps are expensive to purchase. So it's good that you guys locked in a fixed rate.
Yeah, for sure. Definitely helps. That's a good question.
Brian, what are you guys seeing, going across the country, putting in offers, or have you seen seller expectations change at all? Is the level of competition more or less? Like, what are you seeing right now?
Yeah, I mean, there's still, sellers' expectations, I think they've come down a little bit. They're still not where we would like to be, where we're doing a deal every month, but we probably averaged 3 LOIs a week since January, and we're just now getting 2 under contract. So 5 months of not doing a new deal, just because sellers' expectations are high. But there's this mix of, yes, debt has increased, but there's so much capital that's trying to place it in multifamily. You see what's going on in commercial real estate, specifically office space. all that office space, a lot of that office space money is now trying to position themselves into multifamily real estate. People in different industries, tech industries, they're trying to place their money into multifamily. So you have this kind of tug of war between interest rates that what you would think bring prices down, but then you also have all this new capital that's going into multifamily that's kind of keeping it up. So that's why it's super important to try to source deals off market. That's where we're finding most success is off market deals, pocket listings, relationships with brokers. They might have, a relationship with a seller, and the seller says, yeah, you can send this to your list, send it to a couple select buyers, we can shop it off market. We've approached a lot of developers right now. We think there's a really good opportunity in building because right now, 2 years from now, we feel like the market's going to be in a really good position. So that's, historically, building takes about 18 to 24 months. So we think that in 18 to 24 months, the market will be in a much better position. So we've been approaching a lot of developers on that end. But again, sellers' expectations are still high. And here at NWA, it's super high too. Like you're seeing what's getting traded. And we made offers on all those apartments too before they hit the market, but $10 million off, $6 million off where the sellers wanted to be at. So, and they're going to get it too. I mean, there's someone else that's placing their money. There's someone else that needs to place their money worse than we do, or maybe they see something in the market that we don't see, or maybe they're just parking it. Maybe they had a big capital event. Maybe someone had a 1031 exchange, or maybe someone liquidated a business and they're placing it in multifamily. So I would like sellers' expectations to come down more, but we're selling some of our properties too, and we still have high expectations for our properties. So that's like I see their side too. On the seller side, it's like you had this 5-year business plan, and you have these expectations of where you're going to sell. And some of these sellers don't need to sell. The assets that we're going after, a lot of the sellers don't necessarily need to sell. I've looked at some distressed deals, and that takes a lot of manpower and it's a lot of risk too. There's a reason why it's distressed. So there could be opportunities to make money in that, and I think it would take a very dedicated team and a high risk profile to do that. So I think there will continue to be some distressed opportunities in certain markets where you see those C-class properties, where people may have got over leveraged and variable rate debt, didn't have a really good business plan, people who were just getting into it. So those opportunities could come onto the market and adjust it a little bit, but I think there's still a lot of cash flow going into multifamily and keeping it up. And now that debt has started to when debt first started going up, like last fall, it was kind of like scary for a lot of people, and like how high is it going to go? And now we can kind of assess where we think it's going to be. There still is that unknown factor, but I don't think maybe it'll go up another 0.25, but I think it's probably going to be fixed, but maybe another hike, I don't know. But I think we've kind of got an idea of where that's going to. So that'll help people as far as their projections go.
There's a watercolors on a Lowell plan.
Yep.
Is that the same building?
Yeah, same building. Richardson, yep. So we're talking we have first shot at it, so hopefully we'll be in line there to buy that as well. But that'll be a while before that. And they get bought out at completion of construction or certain lease up. So there's also Pure Lowell, I think, is getting ready to sell.
Is that the one right beside JP?
Yep. Yeah, they did Pure Springdale, which got sold. So there's a lot of development going on here in Northwest Arkansas, but there's a lot of people moving here. I think the absorption rate, Northwest Arkansas can absorb a lot of people, based on the vacancy rate. Maybe it goes down a point or two on vacancy, but I think there's a ton of ability to continue to build here. And there's different business plans for building in Springdale and building in Bentonville. Different finishes, different rent levels.
Is there any expansion of more mixed use facilities, or is it?
Yeah, I think so. I think the cities, depending on the city, so a lot of the cities want you to have a mixed use component. They want to have that commercial leasing space to give it more of a community feel than just that, but they also have this need of affordable housing. They need more units to come online, so there's kind of this mix. Bentonville, I know, likes to have, the commercial aspect of it. And then it also, for us, we're looking at this ground up Bentonville deal, and we're gonna put one commercial space on that just because of the extra income. One, it adds to a more community feel, probably put like a coffee shop, bagel shop or something like that, but you're also getting a lot higher rent on that. Maybe it's the size of 2 or 3 units, but you're getting 4 or 5 times X the amount of rent on it. And I think, Pinnacle Heights is a pretty good example of that, for the commercial component versus the multifamily component. I don't like the style of that build, but I think it's going to do well. It's super well located too. Pinnacle Heights, yeah, it's right there in the roundabout, across from Top Golf and JB Hunt.
Oh, okay, yeah.
That one. And then Uptown Terrace is a little bit further. That one's under contract. That actually has some retail component too. That's right next to where I live in Rogers. I like that build a little bit better, but not as much commercial on that. Good questions. Anything else? All right. Well, yeah, I guess appreciate your time today. Hopefully I added some value to you guys on how I look at how I look at deals, how you should be looking at deals, how you should be looking at partnerships, how you should be looking at underwriting. So, do you have next month's?
Yes, for next month, we,
It's May.
here, we have, talking about development, we're gonna be talking with, our development, Mitch Moore. He's gonna be the guest speaker, and he's gonna be talking about multifamily development.
Yeah, that's Mitch Moore. He's a partner at Newell Development. They did the Howard downtown Bentonville, if you know that, where Conifer is. They've done a lot of the townhomes in downtown Bentonville. They've probably got 1,000 units under on the way right now. We're partnering with them, looking to partnership. Hopefully we can announce that by then. But they've got a ton of experience here in Northwest. They're local developers. You see developers from Indy, you see developers from all around the country, but pretty cool to see local developers doing what they're doing. So he can speak more on what to look for on those new builds, what he's seen in the market, what he thinks absorption rates are going to be, and how to look at it from a ground up level. So excited to have this one next month, June 13th.
Yeah, we're still looking to finalize the location, so make sure you're signed in so we can tell you where it's at. Well, in our next email communication, I'm bummed that I'll miss it. I'll be in China, but I'll see you guys maybe in August when I'm back. So.
Awesome. Well, appreciate it, guys.